Welcome, everyone. Today, we're going to dive into a question that seems almost ridiculously simple on the surface, but is actually one of the most fundamental and often misunderstood concepts in all of business. And that question is, when does a company really earn its money? Now, your first instinct might be to say, well, when the cash hits the bank account, right? But as you're about to see, the world of accounting, which is the true language of business, tells a much more nuanced and powerful story. Getting this right is absolutely essential for making smart decisions.
So, let's start with a practical puzzle. Let's say you run a subscription service. On the very first day of the year, January 1st, a new customer signs up and pays you $120 for a full year. Fantastic! Your bank balance just went up by $120. Now, when you're closing out the books for January, how much revenue did you actually make? The gut reaction, the tempting answer, is to say $120, of course. But that's not the right answer. And understanding why it's not the right answer is the key to everything we're discussing today.
The answer to our little puzzle is governed by a core rule in accounting called the revenue recognition principle. And I want you to focus on that one critical word, earned. This principle states very clearly that revenue is recognized, meaning it's officially recorded on your income statement, only when it has been earned. It has almost nothing to do with when the cash actually shows up. So what does earned mean? Well, it means you have fulfilled your obligation, you've delivered the goods, or you've provided the service you promised. This principle forces us to draw a bright line between having cash and having revenue, and that distinction makes all the difference in understanding how a business is really doing.
So, here's our game plan for today. We're going to make sure we've got a solid grasp on the principle itself. Then, we'll immediately put it to the test with three very common real-world business scenarios you're all going to encounter: subscription models, huge long-term projects, and the everyday reality of retail sales and returns. And then we'll wrap up by looking at the big picture, why getting this stuff right is non-negotiable for making sound business decisions.
Okay, let's get right into our first case study. This is a business model you all interact with every single day, whether it's Netflix, Spotify, or any software-as-a-service platform. Understanding the engine room of the subscription economy is vital for any modern business professional.
So, back to our $120 subscription. Yes, the cash is in your bank account, which feels great, but the revenue recognition principle forces us to stop and ask a critical question. What have we actually done for the customer to earn this money? As of January 31st, you've delivered 1 month of streaming service. That's it. What about the other 11 months? February, March, all the way to December? Well, that's a promise you've made. It is an obligation you have to fulfill. And in the world of accounting, a future obligation like this isn't revenue, it's a liability.
This table lays it out perfectly. Look at January. In the cash received column, you see the full $120. But then look over at revenue recognized, it's only $10. So where does the other $110 go? It goes into a special account on the balance sheet called unearned revenue. Think about that name. It's very descriptive. It's revenue, but you haven't earned it yet. And we classify this as a liability. Now, why is it a liability? Because if your company were to shut down on February 1st, you would legally owe that $110 back to your customer. It's a debt. But it's a special kind of debt that you pay down over time, not with cash, but by delivering your service month after month. Each month, you move $10 from that liability account over to the revenue account on your income statement.
Okay, now this is where the theory hits the road. This is about making decisions. Imagine you're the manager. All you look at is the cash flow statement. You see a big spike of $120 in January and you think, wow, we're killing it. We're flush with cash. Let's go hire 5 new engineers. Let's sign a deal for that expensive new TV show. But you're making a massive decision based on a complete illusion of success. Your company's actual sustainable, repeatable revenue for January was only $10. If you start spending based on the cash in the door, you're setting yourself up for a catastrophic cash crunch down the line. This is precisely how so many promising startups run out of money and fail. Proper revenue recognition gives you the true picture of your operations and lets you build a realistic, sustainable budget. All right, let's move on to our next case, which is a fantastic contrast because it presents the exact opposite problem. Here, we're not talking about getting cash up front. We're talking about massive, multi-year projects where you might do a ton of work for a long time before you see the final payment. Think about companies like Boeing building an airplane or a construction firm building a skyscraper. So picture this. Your company lands a huge 2-year contract to build a bridge for $4 million. Now, in the first year, you spend a fortune. You're buying tons of steel, pouring concrete, paying a huge crew of workers. Your expenses are massive. But let's say your contract states you only get fully paid when the bridge is 100% complete. If you waited until the end of year 2 to recognize any revenue, what would your income statement for year 1 look like? It would show gigantic expenses and absolutely zero revenue. It would make it look like your company is a financial disaster, hemorrhaging cash. Do you think any bank would give you a loan based on that? Would any investor want to put money into your company? Of course not. You'd look like a complete failure, even though you might be perfectly on schedule with a profitable project.
The logical solution to this is what we call the percentage of completion method. And the concept is really intuitive. If you determine that the project is 25% complete, you get to recognize 25% of the total revenue. So for our bridge, once we hit that 25% milestone, we recognize $1 million in revenue. When we're halfway done, we recognize another $1 million. This method does something incredibly important. It aligns with another bedrock accounting rule called the matching principle. This principle says we should match our revenues with the expenses we incurred to generate those revenues in the same accounting period. This gives a much truer and fairer picture of the company's financial performance and progress over the life of the project.
Now, put yourself in the shoes of an investor or a lender for a moment. They're looking at your company's financials. Seeing that $2 million in revenue recognized for year 1, even if the cash hasn't arrived, is more than just an accounting entry. It's a powerful signal. It tells them that you are successfully executing a complex, long-term project. It tells them you are hitting your milestones. It demonstrates that you are generating real economic value. That financial statement builds confidence and trust, which is the currency you need to secure more funding or better loan terms. Without this method, your success would be invisible until the very end, and that's just not a realistic way to run or evaluate a business.
For our third and final case study, let's step into the world of retail. This is an environment where you have to deal with a simple, universal truth of business. Not every sale is going to stick. We have to realistically account for the fact that customers will return products. So let's imagine it's the holiday season, and your e-commerce business is booming. In December, you sell 1,000 shirts at $20 a piece. That's $20,000 in gross sales. Fantastic! But you're a savvy business owner. You've looked at your historical data, and you know from experience that come January, about 5% of those shirts are going to come back for a refund. So the question is, if you record the full $20,000 as revenue in December, are you really painting an accurate picture? The answer is no, because you can't truly say you've earned money that you have a very reasonable expectation of having to give back.
So how do accountants handle this? We use a specific tool called a sales returns and allowances account. Now look at the definition here. It's a contra-revenue account. All contra means is opposite. So this is an account that behaves in the exact opposite way that a revenue account does. When you credit sales revenue, it goes up. When you debit this contra revenue account, it also goes up, but it has the effect of reducing your total net revenue. Now, why not just directly reduce the sales number? Because this method gives managers incredibly valuable data. It lets you see your total gross sales, and right below it, you see exactly how much you're losing to returns. It helps you track if your return rate is getting better or worse over time.
So here's the critical step. We take our $20,000 in sales, we apply our historical 5% return rate, and we estimate that $1,000 worth of merchandise will be returned. Now here's the key. Following that same matching principle, we have to record that estimated reduction in revenue in the same period as the original sale. So even though the returns will physically happen in January, we record the $1,000 allowance for returns in December. This prevents us from overstating our December profits only to have them look artificially terrible in January when all the returns flood in. It smooths things out and tells a more honest story.
And once again, let's connect this directly to a management decision. Let's say you're the sales manager and your team gets paid a commission based on their gross sales. In December, you calculate their bonuses based on that big $20,000 number and you pay out some hefty commission checks. Everyone's happy. But then January rolls around and you have to give back $1,000 in real cash to customers who return their shirts. The company is now out that cash, but it's already paid commissions on revenue that never truly existed. That is a direct negative hit to your cash flow and your bottom line. It's an incredibly common mistake, and it happens when companies fail to align their internal incentives with sound accounting principles.
Okay, so let's zoom out. We've just walked through 3 very different business models: subscriptions, long-term construction, and retail. But they all lead us to the exact same powerful conclusion. Proper accounting isn't just about blindly following a set of arbitrary rules. It's about taking all of these different pieces and assembling them in a way that tells the most accurate, truthful financial story possible. This slide right here really is the entire lesson in one single image. On the left side, you have the perception, the cash-based view. It's chaotic. It's a roller coaster of wild spikes and terrifying drops. It tells you absolutely nothing about the underlying sustainable health of your business.
How can you possibly plan for the future with data that looks like that? You can't. But on the right side, you have the reality, the accrual view we've been building. It's a clear, predictable trend line. It smooths out all that noise, and it shows you the actual trajectory of your business performance. This is the view that allows you, as a manager, to make intelligent, informed, strategic decisions about how to invest, when to hire, and how to grow your company.
So why does this matter so deeply to you, no matter what your future career is? Because every single person connected to a business relies on this accurate story. Investors aren't interested in your lumpy cash flow. They want to see your true, consistent earning power. Lenders and banks are assessing risk, and they need to see stable, predictable performance. As future managers, this reliable data is going to be the absolute foundation of every single budget and strategic plan you ever create. And even for employees, this matters. Their job security depends on the company's true financial stability. Accurate accounting is the bedrock of trust for every stakeholder.
So, as you move on from this lecture and eventually into your careers, I really want this idea to stick with you. Your job, whether you end up as an accountant, a marketer, a CEO, or an entrepreneur, is never just about counting the money. It's about understanding and communicating what that money truly represents. Good accounting is good storytelling. It's telling the truth with numbers. So the question you should always be asking isn't just, how much cash did we bring in? The real question, the more powerful question, is always, what did we do to truly earn it?